Good morning, everyone. You're watching a live market outlook for Thursday, 15th of December 2011, prepared by Windsor Brokers. The markets are taking a break after heavy losses, after suffering heavy losses yesterday, and most of the instruments are currently studying and finding to find some base, especially the euro, sterling, and the gold, as well as crude oil, while the dollar now turning into the most popular safe haven instrument is just ahead of 2011 highs and taking break before the possible fresh strength higher. Generally, the current weakness was triggered on last Friday's European Union summit that did not bring satisfactory solutions for the Eurozone current crisis, and the fears of the zone sliding into recession are increasing, and investors heavily coming out of the riskier assets and moving into, as mentioned, the most popular safe haven at the moment, the greenback. Euro hit yesterday fresh 11-month low at 129.45. It's just ahead of another critical support at 128.72, which is the year's low, and the likely scenario would be further weakness, as currently no significant news or economic indicators are due to make any significant change with the corrective bounces in capped for now. More of this will come in our technical part. Also important meeting today in approximately 20 minutes will be the Swiss National Bank interest rate decision and the monetary policy assessment. The Swiss National Bank will strike a cautious note and keep interest rates at zero on today's meeting, according to expectations, as signs of a slowdown in mount and the Eurozone debt crisis increases. Yet it is not expected to announce a shift of its Swiss franc cap that currently stands at 120 per euro. This is by widely expected analysts' poll. However, some rumors were circulating recently about moving back to 130. Now we'll see. The most likely scenario would be keeping the peg at currently 120. The Swiss SNB that capped Swiss franc in their latest meeting on September 6th, after it rose nearly 20% in just a few months, will announce the outcome of a regular policy review, and along with the growth and inflation forecasts. That will be followed by a news conference with the chairman, Philip Hildebrand, and his two deputies. The signs of a slowdown in Switzerland are mounting, and exports have begun to sag. Third quarter growth was the softest since 2011, and inflation has turned negative, and this has led to calls from labor unions and politicians for the SNB to shift the cap to 130 or even 140 to shield the economy. Again, according to the polls, the SNB is not likely to shift its cap on today's meeting, yet it might do it in the coming months, as the Eurozone debt crisis, which sent investors flocking to the safe haven franc, continues to put pressure. Also, the heavy losses. The crude oil suffered heavy losses yesterday after meeting ended in Vienna, the OPEC's meeting, where the OPEC producers sealed their first new output agreement in 3 years in a deal that settles a 6-month-old argument over supplies policy firmly in Saudi Arabia's favor, and bringing now Saudi Arabia again as the leader of the group. You know that there are two groups within the OPEC. One, the price hawks, that is led by Iran and Venezuela, that are forcing higher prices of the crude oil well above $100, and the other more soft group led by Saudi Arabia, the top producer of the oil, that maintains lower prices of the oil and increases the production in order to keep the oil prices anchored. The organization of the petroleum exporting countries, OPEC, agreed a target of 30 million barrels a day, ratifying the current production near three-year highs. And it didn't, in yesterday's meeting, they didn't discuss individual national quotas. The deal now vindicates Saudi Arabia after its proposal to raise output in June to stem rising prices was rejected by price hawks led by Iran, Algeria, and Venezuela. This is what I was talking recently about. And Saudi said it pumped 10 million barrels a day last month, 20% above its old OPEC quota, in what Gulf delegates said was demonstration of strength to the price hawks ahead of the meeting. More about crude oil also will come in our technical part. Now, a brief look at the calendar today. Due to come in a couple of minutes, the Swiss National Bank rate decision, which as mentioned is expected to maintain interest rates close to the 0%, and the peg likely, according to the polls, expected to stay at 120 with this SMB press conference following the rate announcement. German flash manufacturing PMI due at the same time at 8:30 GMT. Forecast slightly lower than the previous release of 47.9, with today's expectation at 47.6, while flash services PMI due at the same time also expected slightly lower at 50.1 compared to 50.3, the previous month release. From Eurozone, flash manufacturing PMI due at 9 o'clock GMT. A slight decrease to 46.1 forecasted for today compared to 46.4 previous release, and flash services PMI for Eurozone at 47.1 today's consensus compared to 47.5 previous month release. From UK at 9:30, monthly retail sales expected to drop by 0.3% compared to the previous month, raised by 0.6%. At the same time, consumer inflation expectations from UK, no forecast, 4.2% was the previous month release. At 10 o'clock GMT, Eurozone yearly inflation forecasted unchanged at 3%, while the core CPI on the yearly basis expected to come at 1.7% compared to the previous release at 1.6%. Employment change in the Eurozone on quarterly basis expected to show decrease by 0.2% and raised by 0.2% compared to the previous quarters, raised by the 0.3%. CBI industrial order expectations from UK due at 11:00 GMT expected to worsen to -20 compared to -19 the previous month release. ECB President Mario Draghi is due to speak at 11:25 GMT. From across the ocean, starting with the US current account due at 13:30 GMT, expected to show the narrowing in the gap to $108 billion dollars gap compared to $118 billion gap previous release. Core PPI on monthly from US at the same time expected to come at 0.2% versus the previous month release unchanged, and weekly jobless claims from US also at the same time expected to grow to 389,000 compared to 381,000 the previous week release. From Canada, at the same time, capacity utilization rate shows the positive forecast at 79.2% compared to 78.4% previous month release. Also from US at 13:30, Empire State Manufacturing Index forecast for today extremely positive at 3.1, versus the 0.6 previous release. From US at 14:15 GMT, capacity utilization rate forecasted at 77.9%, slightly above the previous release at 77.8, and the industrial monthly industrial production at the same time from US expected to show growth by 0.3% compared to the previous month, more positive result at 0.7%. And finally at 15:00, Philadelphia Fed Manufacturing Index, a positive expectation for today. 5.1% is the today's 5.1 is today's consensus versus 3.6 previous release. And now let's take a look on the technical part and see the latest development. As we can see on the 4-hour chart, euro is in the steep downtrend with the loss of significant supports at 131.45, 131, and then the psychological level at 130, extended losses so far to 129.45, where the channel support line was tested. This is the lowest for now. The low hit late yesterday, pardon. Currently the pair is consolidating recent losses with the still negative studies expected to show the mild correction with the immediate barriers at 130.63, then 131, and 131.60, which is basically expected to cap the upside for now. Only break above 132, 132.35 might signal some stronger corrective action, and signal temporary bottom at 129.45 ahead of stronger action higher towards 133, 133.30 as initial barriers. However, the downside remains favored for now, despite quite extended near-term studies with the levels at 129.00 as a figure support, and then the critical level at 128.72, yearly low posted on 9th of January, seen in focus for now. A break below the channel support that was only tested yesterday would likely accelerate losses, while loss of 128.72, where a number of stops is placed just below, also might see the further acceleration of the downtrend of euro against dollar, as the broader picture shows that the pair is in steady downtrend from 149.38 high of 2011, with the recent loss of 61.8 Fibonacci retracement of the longer term uptrend from 118.75 to 149.38, seen more bearish at this point. The cable is also consolidating after hitting a fresh low at 154.07 yesterday that marked the full retracement of the short-term corrective phase from 154.22 low of 25th of November that was capped at 157.70 zone. Now break below, clear break below 54.22 and 154 is to confirm the double top short-term double top pattern on the 4-hour chart and open way for a further extension lower. The initial support at 152.71, which is also the range floor of the longer term range, wide range between 152.70 and 167.37, is expected to signal to confirm the top at 167.45 on the longer term, and open way for a further weakness of British pound against dollar, with 150 level seen in focus in case of firm break above 152.71. Back to the near-term outlook, corrective bounce currently underway on oversold near-term conditions, faces initial barrier at 155 and 155.30, which is break point at this point, and likely to cap the upside for now. while only break above 155.30 is to open stronger recovery 155.60 and then 155.80, which is the channel support, would be the next levels in case of break higher. Dollar yen in corrective mode, but overall the picture still stays positive, as the latest dips below initial support of 78 were initially capped at 77.90. The bull trend line drawn from 77.12 low of 8th of December. This keeps the immediate bullish tone in play, while holding above here with the 20 days moving average on 4-hour chart currently at 77.94, also attempting to contain dips. Immediate focus remains on the upside with a break above 78.14, which is the low, which is the recent high. To focus next level at 78.27, 29th of November high, and possible extension up to 79, seen on the extension above 78.27. It's important at this point to hold above 77.90. That will keep the immediate bulls in play. However, further extension down to 77.63 would not be that harmful for the pair as long as 77.50 holds the downside. However, the ideally reversal at this point just above 77.90 would keep immediate focus higher, and the 78 and 78.15 highs to come under pressure. Dollar Swiss in near-term corrective mode after a strong rally, extended gains through psychological barrier at 95, hitting 95.45 so far. This was actually our initial target above 95.45. 95.46 I think was mentioned in the yesterday's technical outlook for majors. However, the positive tone still persists as shown on the daily chart. Overextended studies see scope, and the corrective pullback is underway with initial support at 94.30, where also 20 days moving average stands, and then 94.00, 93.80 zone that is expected to contain dips in order to maintain the current immediate bullish tone. Break above 95.45 opens 96 with the significant level seen at 97.70 zone. These are the highs of February 2011. Actually, these are the yearly. Are they? They are yearly highs of 2011. As mentioned, the daily outlook also is in positive, but touching the oversold zone might signal stronger corrective action to the downside with 20 days daily moving average at 92.55. That maintains the recent gains, expected to keep the downside protected for now. The crude oil is in defensive after yesterday's steep fall through initial support at 97.30 zone, extending actually the full retracement of the latest 95 102.42 rally, extending losses below our initial and strong support at 95, hitting 94.20 so far, and turning the near-term studies into negative territory. Current bounce is for now seen corrective as long as 97.30 as previous support now reverted to resistance, where also 20 days moving average stands at this zone, expected to cap for now, and resumption of the short-term downtrend from 102.42 would be the likely scenario, as daily studies are losing momentum and the MACD is approaching the midline. Further and loss of 200 days moving average favors the further weakness, with firm break below our critical support at 95.00 to open 93.00, where is 55 days moving average currently standing ahead of the next stronger level at approximately 90.50 zone. The gold is also in a strong defensive loss of 200 days moving average, and the 1600 support has so far extended losses to 1563, with the outlook in the short term quite negative, and expectations for a test of 1532 widely expected. On the upside, corrective action now is expected to be quite mild, with the initial barrier coming at 1600 as previous resistance now reverted, previous support now reverted to resistance, with the 1620 coming next, and the 1660 zone expected, 1660-70 expected to cap the upside. 20 days moving average at 1634 currently pointing lower, and maintaining the current downtrend of yellow metal.